you so much for having me here today. It's always a pleasure being with the Trading Pub and Morgan and Yana and Raleigh. Thank you so much. Yeah, so what I'm going to talk about today is kind of my passion, options, and I'm going to talk about option income strategies and my favorite one and show you exactly why I like it so much. So we're going to talk about step one. This is kind of a five-step plan that I use. That I like to present to kind of show you the ins and outs of options and what you should be looking at. So step one is avoiding the number one option trading mistake. Step two, most important option factor. Step three, how option pricing works. Step four, knowing and using the market maker's secret. And step five, highest probability option strategies for every market. And the following webinar, it's only for educational purposes. Any stocks, options, futures mentioned does not constitute advice and not be constituted as recommendations. So I appreciate that introduction. And yeah, I've been actively trading for over 30 years and became executive vice president for one of the largest oil trading companies in the world. And we pretty much, if it moved, we traded it. So it was a really great learning experience for me, and I was very blessed to have had the opportunity. We were one of the first groups also to start trading options on over-the-counter crude oil options, and I started doing this in like 1987, and that's where I got my first taste of option trading, and it's kind of stuck with me ever since. I went on to launch the institutional over-the-counter crude oil option brokerage desk for PVM Oil London, the privately largest oil brokerage company in the world, and that was another really great experience. Learned a heck of a lot more on options, doing a lot of big option structures there with a lot of the banks and big hedge funds. So it was a lot of fun and another great learning experience for me. So what I'd like to do, if we could start out, just kind of get an idea from everybody here today about where you are in your trading. And if this is something you'd like to be doing, for your career or something that you'd like to do full time. So if you could just put a simple yes or no, I'd appreciate that. I'd like to get a feel for everybody that's here. This will also wake everybody up. It looks like lots of yeses, so I appreciate that. So I'd just like to make a comment, though. We all have to start somewhere, and I used to be exactly like everybody here in the room. But back when I was running the international trading desk, at the end of the day, we would always look at our numbers to see where our P&L was. And if the losses were bigger than the gains, I'd be upset about it. I'd be pissed about losing money. But it really didn't affect me personally at the end of the day because it wasn't my money. It was the guys running the desk for, and he was a very wealthy individual. So, I still got paid at the end of the month. I would get a bonus at the end of the year usually if I didn't screw everything up, which I didn't. And, it was a great experience. But when I eventually went out on my own and started trading for myself with my own money, it became a totally different reality for me. When it's your own money, it's a real game changer. So, when it's your money up there and the losses come in, it becomes a lot more personal. When I was coming home from work, when I was running the international trading desk, my wife, Camille, she would, really never ask me, well, how'd your day go? Did you make money? Did you lose money? That kind of thing. No interrogation on that. But she could tell, by my mood if it wasn't really a good day. But she also knew that, I was going to get paid. But again, when it came down to being our own money, well, let me just say she started asking me a lot more about how the trading day is going. So I can understand probably you guys get the same kind of feedback. And I know what it's like, when you have expenses. I've got two boys in college. So, it's something that becomes a little bit more personal, obviously. Now, one thing, though, trading for yourself can be one of the most rewarding jobs on the planet if you're educated about it. And about what you're trading and the important things about all the aspects. So I always like to tell my members that there's no perfect trader, there's no perfect system, and it's a continuous journey of learning. So stay after it. I'm still learning each and every day as well. So the one thing, though, I would also like to say is that once you start, or if you do start using options, and what I'm going to show to you today, it can make your stress level and your profits a lot more consistent and a lot easier to control risk. So it's going to come down to talking about income option strategies, and I'll show you in this presentation what I mean. So ask yourself this, what if you could add a new stream of income now? Would it change your life? And if the answer is yes, then do you have a plan to achieve this goal? So first off, though, in this plan, step one is avoiding the number one option trading mistake. Now, option trading has many more advantages than trading stocks, but it can be a little bit complicated as well. And for the newbie or the beginning option trader, it can be a little intimidating also. So that's why many investors decide to begin trading options by buying short-term options, or in this example, I'm going to say short-term calls, and especially those out-of-the-money calls where the strike price is above the stock price. Since they seem to follow that old familiar pattern of, let's always look to buy low, sell high, and that's a great pattern. But always buying options, is this always the best strategy? So in this example, I want to illustrate to you, perhaps maybe it's not the best strategy to do this all the time, just buy. So imagine you're bullish on Facebook and it's trading at $65. Now, as a beginning option trader, you might be very tempted to buy calls 30 days from expiration with a strike price of 80, and at that strike price, the cost of those calls is going for 15 cents or $15 per option contract. And why would you do this? Because when you look at it, you can look at it and see that you can buy a lot of them. So let's do the math and see where this leads. And remember, one option contract is equivalent to controlling 100 shares of the underlying or stock. So if you were to purchase 100 shares of Facebook at $65, that would cost you $6,500. But the same $6,500, you could look at that and say, wow, I could buy 433 contracts, though, of those 80 calls, and then I could control over 43,000 shares. And you look at that and you think, man, that is just unbelievable. I can control all that volume, all those shares, and the potential profits are just humongous. So then you imagine Facebook goes and hits $81 within the next 30 days. And then those 80 calls you're looking at, they go to $105 per option contract just prior to expiration. So when you do the math on that, you figure out, well, you can make over $38,000 in just 1 month, off that initial investment of about $6,500. So, at first glance, it looks fantastic, and it is awesome the leverage that options can provide you, but, don't always let the glitter fool you. So when you dig into it a little deeper, the one problem that comes up with short-term out-of-the-money calls is that you not only have to be right about the direction the stock moves, but you also have to be right about the timing. And this then really ratchets up the degree of difficulty. So to make a profit, the stock doesn't just need to go past the strike price, but also it must do so within a defined period of time. So in the case of the 80 calls on Facebook, you would need that stock to reach $80 within 30 days to make a profit. So in this example, you're basically asking the stock to move more than 23% in less than a month. And in this example, this would be a 2 standard deviation move. Now that's the cool thing too about options. We've got some really great tools that we can use that can give us some statistical probabilities to work with. And then you look at that and you think, well, how many stocks are likely to do that? Well, there are those that will do it. We've seen Tesla and some of the other high beta type stocks will do these moves, but in all reality, not many. So in all probability, the stock would not reach that strike price and the options would expire worthless. So based on probability, and we can again use probabilities with options using standard deviation, there's only about a 5% chance for this stock reaching 80 by expiration in this example. So in order to make money on out-of-the-money calls or out-of-the-money options, you either need to outwit the market or get plain lucky. So, we used to always kid around the trading desk that there's an old blues song that went something, one of the lines was that if I had no bad luck, I'd have no luck at all. And I don't know how many of you, usually if you make a mistake or something, usually you don't get the luck to you. It's usually the bad luck that comes out. So it doesn't usually go your way. So that's the tendency. So, by understanding the underlines and all the different ins and outs, it's going to help you as a trader. So that's what we're going to be exploring here today on these options and selling options. So again, like being close means no cigar. So imagine then the stock does go up and it goes to $75 during the 30 days of that option lifetime. Well, you could be, patting yourself on the back that you were right about the direction the stock moved, but since you're wrong about how far it would go within a specific time, you'd lose your entire investment. So based on this newbie option trader mistake, a better goal for every trader would really, in my opinion, be to select trades based on what provides the most consistent positive returns and not just the greatest returns. And one of the best ways to achieve this is by using option strategies that take advantage of selling options for income generation. Now, by selling options, we're in essence selling time. And an option, you can look at it kind of like it's like a coupon. It must be redeemed by a certain expiration date or else it's no longer going to be valid. But how is this done and what's involved in this process? So that's step 2. Okay, so the most important option factor for income generation really comes down to time. And time value is what we use in options. And it's using trading strategies that take advantage of the accelerated time decay of an option into its expiration. And option income strategies, they're very, very tied to time value and the impact that it has on the price of that option. So what is time value? Well, in options, we also call this the extrinsic value, or the extrinsic value of an option. It's the premium a rational investor would pay over its current exercise value, which is the intrinsic value, based on its potential to increase in value before expiring. So, as a buyer or investor, you're going to be willing to pay a little bit of extra money to get that additional time to give this particular trade you're looking at to work out. And as that seller, by giving that additional time, you're going to want a little bit extra premium. So that's how it tends to always work out. Now, this probability is always going to be greater than 0. Thus, an option is always worth more than its current exercise value. So here's a chart to kind of illustrate that. If I can find the little pin here. I use GoToWebinar, which is what I'm familiar with, but let's see, I think the pin is, well, if I can't find it, I will just try to point out with the pointer here. Yes. So basically, when you're looking at this time chart for options going into an expiration, you can see that when you're starting out way out here to the left of this chart, the time decay is going to be very, very small, and we call this the theta decay. We use theta decay as the term, and the tool on your option platform can tell you exactly how much each day the value of an option is going down based on that theta decay. So when you're out here 120 to 90 days out, that theta decay is very small, and then as you get closer towards expiration, it really starts to accelerate. So when you're 30 days out, that's when it really pops up and starts to accelerate. And then when you get to those weekly options, I call it time decay on steroids. So it really tails off. Before you know it, you're at zero. So when you're out here 120 to 90 days out, the theta decay, you can see it on your platform, might be 1 cent or 2 cents, which is at $1 or $2. And then as you get closer in, that goes to $5, $10, 20, 30, 40, 50, until there's no value left at all. So that's what you have to be careful of. When you're buying options going towards an expiration, you're, in essence, really kind of swimming against the tide. So you need to always be aware of that, especially when you get inside of 30 days. So be aware of that. So this is another reason that perhaps sometimes it's better maybe to look at selling options. So and then step 3 is then, well, then how do options price, and how does that work, the pricing of an option? Well, the core components that make up the option price, the main components, will be time value times implied volatility times the intrinsic extrinsic value. Now, there are other elements that go into the pricing, but these are the main components for pricing an option. And once you know these variables, then you're ready to go. You're ready to price an option and know what its option premium should be. So the core components then are made up of the implied volatility of the option, and this is basically just what the marketplace is currently implying the volatility of the stock or underlying will be in the future based on price changes in the option. And then you have the intrinsic value. That's the amount an option is in the money. And then you have the extrinsic value. That's the price an option less that intrinsic value, or it's the out of the money portion of that option. So here's a table, and I can illustrate a little bit better. Let me see if I can find that tool. I'm looking around. I see my little tools here. No. All right. Well, we'll just keep going. So here, if you see this, you're seeing this table here, and what you see is this is a weekly option series. So every Thursday, you get a new series of options that come out, the weeklies, and they're going to expire. They'll be 8 days later. So when you look at it, when you first have that series on Thursday, it's got 100% time in that option, and then on this particular illustration here, I put the intrinsic extrinsic value. I set it at the constant of 1, so you can see how the math flows through to create the premium, which is the cost of the option. So it's the time value times the implied volatility times that intrinsic or extrinsic value of the option, and that gives you your option premium. So you can see here on Thursday, you've got 100% time, put the implied volatility at 300 times the intrinsic, extrinsic, you get a cost of $300. Now, if you go down to Friday, you can see you're going down in time values decayed about 1/8 right there, and you kept the exact same implied volatility, but now you can see your premium has gone down to $262.50. And then when you come into Monday, you can see it's half. That time value's been chopped in half because of the time decay. And even if you increase or have that implied volatility spike up, it barely pushes your premium. It only goes to $400. So eventually on Friday, then you've got 0, and that's what's working against you as a buyer. So it's very important to know where you are within a series, an option series, in order to know what's going to happen to your option pricing based on this theta decay. Now, step 4 is a really important factor that I keep finding lots of traders really don't understand this concept. And this is, to me, this is kind of an aha trading concept that can really help anybody's trading, even if you're not an option trader, because what this market maker secret will tell you is a way that you can look at targets based on implied moves of an option. And this is information that's free. So it's a really helpful market information. and it's what a lot of traders really don't know or don't understand. So when you think about it, broad markets, if you look at your charts of whatever you're trading, you'll see that you'll tend to have moves, that'll be nice sustained moves, maybe 2 to 3 weeks up or down. And then you'll see the price action kind of go sideways in channels, maybe 70–80% of the time, because nothing can go straight up, straight down. Everything seems to expend energy, and then it has to kind of take a rest to gain the energy back. And then you want to see, okay, what direction does it go? Does it consolidate and then continue within the trend that it was going or that was in, or is it going to go reverse? So, based on this sideways type price movement, if you're constantly buying out of the money options, if you're an out of the money buy an option buyer, and that's all you do, the statistics are going to say that you're going to lose approximately 78% of the time. And we'll go through and show you an example of why that is in just a minute. Now, the market makers know these statistics, and therefore they're going to tend to trade from the sell side. So this is the professional money. So it's really a good idea if you understand, well, why are they doing this, and then think like a market maker. And it all comes down to the math, and it's all based on math. So this is what happens. So the market makers, they are going to use mathematical market probability statistics for pricing the movement of an option to its expiration. So these are the option models, and they just plug in certain variables. Now, this is all theoretical, but this is how it's done. Now, knowing the probability of an underlying security finishing within a certain range at expiration is the key when determining what options to buy or what options to sell and what option strategy to implement. Now, these statistics forecast how likely it is that an option will fall within a certain price up or down by its expiration. And it's this statistical forecast, it's referred to as the implied move of the option. So it's this implied move of the option. This is that theoretical estimate of a plus or minus 1 standard deviation move of the underlying security by its expiration. So, this is a lot to kind of probably absorb when you first go through it, but I'll show you some examples of this. And basically what it is saying is that when you look at probability distribution, you're going to see that as you go further out on these options, buying puts or buying calls, theoretically, you're going to have a lower probability of having those in the money at expiration. So we'll go through this, but it's based on these probability statistics that short vertical spreads, or what we call credit spreads, when used correctly, will provide a trader or investor the greatest probability of success and are best ways to generate a steady stream of income. And it's all based on the math. So once you understand this, you'll see, and this might be a kind of an aha moment for you to incorporate it to what you're doing. Now, in this example, you'll see this is a distribution curve, which is statistics. If you've taken any statistics, you're going to always recognize this bell curve. And it's just when occurrences happen over and over and over, you can put a distribution together as to the approximate probability of where those certain price points will fall. So here you're seeing, this is an example of Google. And on your option platform, whatever platform you have, it's going to either give you this implied move information of plus or minus 4%, or it'll give it to you in certain ways if you understand how to go about to find it, but it's there. Now in this example, we're going to say that Google's trading right here at $500, and it's right there up at the top of this bell curve, and that's at the money. Now options are always start the price at the money. That's where all, if you think about it, that's where all the supply demand, it starts at the money. And then the option makers will then they'll set their, what they call their skew to determine the other strikes away from that at the money strike. And so you always have to have what the approximate theoretical implied move is, and then you also always have to have days to expiration. So this is part of the formula that they're going to use. So once you have these two components and you know where the at-the-money price is, then you can start using this to understand where the probabilities of that price distribution is. So if you look at this bell curve here, you see $500. That's Google trading right now in this example at 500. And then the market makers are saying, okay, well, the statistics tell us that this has the probability to go down 4% or up 4%, and the price is going to fall between these 2 points by expiration, 10 days, and that's a 1 standard deviation, theoretical 1 standard deviation move. So it's either going to be between 480 or between 520, and that's the 1 standard deviation, and that's 68.2% of the time. So that's a theoretical, but that's how all these option models work. So by looking at that, you can see if you start always buying options 520, 525, 530, 540, they look very attractive based on like that Facebook example because they're cheap. But what's the probability that you'll actually be in the money, the underlying will be there at expiration? It gets very, very small. So if you think about it, you're getting a really great, huge return if you do get out the money. You know, you're making hundreds of percent, but that's because you're taking a lot of risk. So if you're an investor or trader, you want to get paid for risk, right? If you're taking a lot of risk, you want to get paid extra, and that's what you're doing when you're buying way out of the money. So this is the way that the option market makers look at it. So using this probability analysis, this provides a trader a very useful tool for determining price targets to trade against, and it's free on most option platforms. That's a really great thing too. So based on the math of probability, you start to see that approximately 68.2% of the time, or 70, just around it, percent of the time, options bought out of the money expire worthless. And it's based on this that's a good idea for any trader or investor to not only consider buying options, but also consider selling options in certain situations. So this, added option strategy, it can really make a dramatic and positive difference in your trading performance if you're using it correctly. So remember, trading, it's a business, and you need to treat it as a business, not a hobby. And it's a business of probabilities. So to be successful, it's all about controlling risk and having consistent winning trades, and that's what's going to win the race in the long term. So it's another thing too. As you get older, we all, I think, probably like a little bit less stress in our life. So when you're really aggressive trading, that's one thing. It's great, you make a lot of money, but along those lines also comes a lot more stress. So I like to kind of balance things to try to find trading opportunities and style of trading where I really have a good defined risk, and it also helps me to reduce my stress. So it's kind of a money stress formula that I like to incorporate because life's basically too short if you're constantly stressed out. So step 5 then is selecting the right income option strategy. So again, the goal of every trader or even investor should really be to select trades based on what provides the most consistent positive returns. So you don't always want to be looking for those huge home run trades. Look for the singles and the doubles. And the best way to do this, in my opinion, is really by understanding income option strategies that are out there and available, and then select one that best suits you for your trading style or your trading plan. Now, everybody here today, we're all going to be different. We're all going to have different capital accounts to trade. We're all going to have different risk tolerance, and we're, different lifestyles, different time frames that we live in, different markets maybe we want to trade, things that we have to do. So you have to pick what makes sense to you to trade based on your lifestyle a lot of times. And so with income option strategies, these are the main ones that are out there. So you have covered calls, you have calendar spreads, you have diagonal spreads, long iron condors, and credit spreads. So these are kind of the main ones. Now, a lot of you maybe have used covered calls. Calendar spreads are good, diagonals, but these three, and even the long iron condor, these are for certain market situations, and they're not really something that you really should use all the time. So if you think about a covered call, if you're familiar with a covered call, it's a great strategy if the market's going up, but what happens when it goes down? Calendar spreads can be the same way, diagonal spreads the same, long iron condors same. So they're all great strategies for the certain situations of the market. But the one that can be used in any market situation is the credit spread. So that's what I'm going to kind of be focused here more on today, is just the credit spread. Now, the credit spread is called the short vertical spread. That's known as credit spread. And there are basically three types that you can use. There's the bear call credit spread, there's the bull put credit spread, and then you've got the combination of the two above, bear call and bull put, is the long iron condor. And we'll go through all of these to show you the differences and how they work. And then I want to show you also a big thing on the risk factors, the profile on just buying directional options versus using a credit spread. So it'll really be an eye-opener once you see how it flows. Now, the first short vertical we'll talk about here is the bear call credit spread. And basically all it is they're real simple construction. It's just going to be long a call while short a call, but the short call has a lower strike, and they're always in the same month. And we'll go through some examples. And then the bullish strategy is the bull put credit spread. Now this is going to be short a put while long a put with the lower strike, always in the same month. So these are low cost, these are directional type trading strategies. So you really, for these two, you have to have a view on direction. So, these are, and I'll show you why these are directional and why they're used versus maybe just going long a stock or going long outright a call or outright a put or a debit spread. So they are low cost, they're defined risks. So, you've got a defined risk factor, and it's also going to define your profit, but it's a great strategy to use. Now, when constructed properly, these spreads are excellent for premium collection. So here's the first example here, and let me see here. I was trying to, well, usually there's a pin up here, but I don't see it, so I won't. Well, anyway, we can move forward. Hopefully you can kind of see my pointer. So this first slide here is an example of a bull put credit spread. So this is a strategy for a bullish view of the underlying that you're trading. So in this case, it's this example's on WYNN, W-Y-N-N. And if you look at this chart, you'll see two horizontal lines down towards the bottom. You'll see a red one right here where my pointer is, and then a blue one under it. So this is the bull put credit spread. So if you look at this, you'll see down here, you'll see sell to open STO 187 put at $513 per contract. And then below that in blue, you'll see, or yellow, you'll see buy to open 182 put at 383. So if you look at the difference between that, your credit received is going to be the difference. You're going to get $130 here, and it's a $5 wide spread. 187 minus 182 is 500, right? So it's a $130 credit. Now these credit, when you receive a credit on a spread, on an option trade, it goes straight to your bank account, and then the goal is to keep that credit at expiration. Now you'll also see here then the max loss is only 370. So the maximum, if you did nothing on this trade, you would only lose 370 and your profit's 130. So if you look up here, return on margin, you can see that at expiration, that red line, the horizontal line down there, It's, if it, as long as the win closes at 187 or above, you keep that $130, and your margin or capital at risk was 370. It's a 35% return. Now this was over about a 15-day period. This was about a 22-day period. So 35% return, and that's not a very bad. That's a pretty good little return. But again, you're not going for home runs. You're going for consistent profits. And if you look at this chart, you can see that win really has to fall apart to get down here to your short strike, where you're going to be threatened to really go against you. So that's the thing I like about it. Now this is based on selling at a 1 standard deviation move below the current price, when at the time was 207. So that's what a bull put credit spread looks like. That's a bullish strategy. So you can see here, if you look at the price chart, it goes up, comes down, but you still make money. Now here's a bear call credit spread. This is a bearish market strategy. And I like to use the CBOE index. I like to use the SPX, the RUT. I like those a lot. Sometimes the NDX. So all this index is just one, it's like SPY. It's 10 times the SPY. So if you had one contract of the SPY, this would be basically 10. So it's just a good way to optimize and leverage without paying as much commission. So this is based on the S&P 500, and it's cash. So you can see here, the red line up here, that's your short call, the 2045 call right there. And then the 2050 is the green line. That's your insurance premium. You buy that, so you're not going to have an unlimited loss. So here you can see, by doing this spread, you collected $100 credit straight to your bank account. The difference in the spread was $500 less that $100 credit. So you're at risk. Your margin on this trade would be $400. And as long as it expires below that red line, 2045 at expiration, you keep that whole $100, and that's a 25% return on your capital at risk. Now the other way too that's pretty cool to look at these option trades like this is that once you have that $100 in your bank account, every day you're making money. So every day that theta decay ticks away, chips away at it, and that $100 just stays in your bank account. Every day you make money. So that's the bear call credit spread. And then you can see here, you've got all that sweet spot, up there. It really has to go up hard against you before you start taking some heat. And that's the other thing that kind of reduces stress. So if this market in this particular situation doesn't have that movement you want and just kind of goes sideways, you're still making money. But you're far enough out of the money here where you're not taking a lot of heat if you set these things up right. So then you've got the long iron Condor. And this is just your combination of the bull put credit spread and the bear call credit spread. It's just both of them together. And there should be, for constructing it properly, it should be equal distance between each strike price. And you want the underline should be between the two credit spreads or short options. So these are another nice way you can leg these, since they're two separate spreads, and when you put them together, you don't have to put them on at the same time. You can if you want, but not all the time. So here is an example of an iron Condor, and it's on Amazon. So if you look here, down here at the chart, you'll see Amazon, that price is just kind of going sideways. So if you're taking a view on the market with the price moving sideways, then it might be a great trade setup to sell the bear call credit spread up here and the bull put credit spread down here. The combination of the two together is your long iron Condor, and you collect on this particular trade setup $150 credit right to your bank account. It's a $500 wide spread, so the difference is $350. That's your margin, that's your at risk. And if you did nothing on this trade, that's the maximum you'd lose. Now the other thing you'll notice is that this is a negative risk reward, right? So your potential loss is greater than your potential profit. So a lot of people don't like that, but what you have to understand is if you look back at what we just went through, probabilities, that if you're up here and it's 70% probability or greater that these options will expire, they're not going to expire up here because the probability is against you, then that increases, these are consistent higher probability trades. So if you're buying options up here at that 350 level, based on probabilities that we looked at on that distribution curve, your probability of that being in the money could be less than 10%. So that's what you're looking at. So that's why you're having that negative, risk ratio. You're going to get less return because there's less risk, because there's a higher probability of these trades closing away from these strikes based on these option models and the probabilities there. So here's what it looks like, if you expand out the chart a little bit. You've got that short leg, that red line there is your short call, your long call, and your short put down here at the 320, long put. And, every day it goes sideways. These short options just decay, decay, decay until they're finally at zero at expiration. And you have to do nothing. You don't have to close the trade out or anything. They just automatically expire, and you just have the money just sit in your bank account. So this is something that will help you understand the risk versus reward of using a credit spread versus just the traditional buying calls or buying puts. So in this example, you're going to see two strategies. The first is just buying the directional calls. You're looking for this particular example. It's going to be on when. You're looking for when to go higher, and based on that assumption, this strategy one is you're going to buy options to take advantage of it going higher, and strategy two, to take advantage of it going higher, instead of buying directionals, you're going to sell an out-of-the-money bull put credit spread. And so you'll see the difference in the risk when you do these strategies. So here are the two strategies. Strategy one is just going to buy at-the-money June $207 calls. And those were going at $11.40, so that's $1,140 per option contract. Now, that strategy, it's a good strategy. If when goes up, you're going to make a lot of money. And your potential upside profit is theoretically infinite. Your max exposure is, what you paid, so it's $1,140. Now, for a lot of people, that might be a lot for your account. $1,140, so that's one thing that might be kind of a detriment, or it might not be. Now the second strategy though is selling that out of the money bull put credit spread. So you're selling the 187 puts, buying the 182 below it, and when this was put on, Win was trading at $207, and if you look at the next chart I'll pull up, you'll see that the low was about 189, and this was put on at 9.5% below where Win was trading at the time of 207. So here's what it looks like. Now this is Win, this is the strategy one, just buying directional options. And so if you look at it, you'll see right here in the middle of that chart, $207. So that's where it was trading. You bought those at the money calls. It cost you $1,140. And you could have just bought the stock here too. You could have bought stock, options. You're looking for the market to go up. Well, it popped up, but then all of a sudden it fell off hard. And when you're coming in here looking on May the 8th, Win is now trading down at $196 right here. So when it fell down there, I mean, markets move fast, right? So it fell down there, and all of a sudden that directional calls that you bought, that contract now is down $583 per option contract. Now that's smarts, So then on the 21st over here though, when finally comes back up and it's trading at $205, but you look at your P&L and you're still down, you're not down as much, but you're still down $518. And that's still, smarts. Now, strategy two is selling that out of the money bull put credit spread. So it's a long bias trade, but based on the structure, you're not going to lose, but if you're wrong, you're not going to lose but $370 here. And if you're right, you make that 130, which would be a 35% return. And you can see here where Win was trading at 207. Down here, that red candle there, that low is 189. And the short strike is 9.5% below the at the money where Win was trading the day that was put on. So that was the 187 put short, 182 put long. And look what happens here. Win rolls over and crashes down on the 8th of May. And this credit spread now is only down $38.50. You can see your open P&L, but your long call was down 583. Huge difference between the two strategies. They're both bullish, but here you're only losing 38.50. Here you're losing over 500. Now here it is on the 21st. When Win comes back up to 205, you can look here on this out of the money bull put credit spread. You're down, now you're up $78.50 per contract, but you're still, if you're long the calls only, you're still down 518. So the thing about this is that it can really help you to minimize loss, but it can also help you to diversify risk, because what I'll do a lot of times, I'll buy long calls too, but I'll also do credit spreads along with it. So let's say I have a $2,000 to put on a trade based on my trading rules, whatever. Instead of putting all $2,000 into buying long calls, I might put $1,000 or $1,000 into a credit spread and the other $1,000 into the long call. So you can see that if I'm wrong, I would lose 518, but I'm still going to make money on the other one. So this is a good way to diversify risk, and I'll usually put more towards the credit spread than I will towards these long options. And if you get it right, they both pay out for you, and that long call option, makes you a lot of money. But it's a great way to do what I call kind of a basket trade, where you can really diversify your risk by incorporating these credit spread strategies along with whatever else you're doing. So the next thing I wanted to show you is my favorite option income strategy, and this is the in-the-money vertical credit spread. And it's a really cool structure because it has a positive risk ratio. I showed you the negative risk ratio of the out of the money. This is in the money, and it goes positive. So these are some examples just to illustrate exactly what I'm talking to you about here. So this is on Tesla back in August, and these are short-term trades. You can use these for long-term or kind of weekly option short-term trades, and they're very directional driven trades. And I like to use these when there's good momentum and a potential for a really good momentum break out or break down. So these are kind of one of my favorite strategies for this, and I'll show you a number of examples. So it's all based on direction, and here this is based on my trading model that we use, and this is Tesla, and it was traded at the time $229. My indicators, you can see these dots here, that indicates what we call volatility squeeze. And so then there's good potential for a big, hard momentum break to the upside or downside. Here my momentum indicators were saying potential probability for this breaks to the upside. So let's get ready for a trade. So you could either, buy Tesla at $229. So that's going to be, if you did 100 shares, that's $22,900. Or you could buy some at-the-money calls. You could do a call debit spread. Or you're going to see, you could do an in-the-money bull put credit spread. You're going to see how this positive risk ratio really has a nice risk reward to it. So here's the trade setup, and this was Tesla. You can see in the red here, the short legs at 240. Now you look here at the time it was trading at $229. It had the implied move here, based on the option platform, was plus or minus 4.8%, and that was on a weekly option, within 7 days. So then what you do is you look using that implied move. I set my target high off of that, and that gave me a target high of $243. That's the implied move high, and then the implied move low by expiration is 221. So what I will do is I will set my target that I'm trying to hit inside of that, right? So I have even a higher probability of making that target. So here the spread was set, the short leg at $240. The market was trading at $229, so that's $11 in the money. Now, you look at the credit spread. On this credit spread, it's selling the $240 down here put, buying the $237.5 put below it. So it's a $2.50 wide spread, or $250. On this spread setup, collected $217.50. It's a $250 wide spread, so the difference is only $32.50. That's then your max at risk. That's the cool thing about it. So you could potentially make $217.50, and if you're wrong, the maximum you'd lose is $32.50. That's a huge positive risk ratio. Make more than you lose. So that's a 6.69 to 1 positive risk to reward. So if this closes above your short strike, which was 240, you keep that full credit, and your max at risk, your margin put up, 32.50, that's a 669% return. So here was, put on the 1st, expirations on the 8th, took this off early. Didn't want to sit or wait around. I usually take these off on a Thursday just because of its potential assignment. But the thing is that I like to do the high beta type stocks for this type of strategy, because you have a couple of factors. You could get assigned, but with the high beta, you're going to have extrinsic value that the buyers are not going to want to get rid of, because there's still extrinsic value left in it. And then there's also another thing that we call gamma risk, and at the expiration it can go crazy. And so on these high beta stocks, it doesn't really pay to exercise early on them, because that gamma risk that you can run into. So on this one, took it off with $192, and that ended up being a 590% return in just 7 days, and on a risk of $32.50. So that's pretty much, in my book, kind of unbeatable. Here's another example. This is on Baidu back in September. September. This was another bull put credit spread, and I call this a price target option strategy, positive risk ratio, because you need to set it up with a direction in mind and have targets that you're looking for it to hit or exceed. So that's the key. And you'll notice that on my examples, they're all kind of the similar setups on these, and this is what, again, I call a volatility compression breakout type trade. You see these dots. That, based on my model, tells me when price goes into this kind of compression period. And then what tends to happen, you get a really good burst of energy, either up or down. So then the question is, okay, is it going to break to the upside or downside? And then using my momentum indicators, it gives me a probability that in this situation, you see it's going to break to the upside. So I can do a couple different things. I could just buy, in this situation, Baidu at the money, the shares, or I could buy at the money calls. I could do a call debit spread, a lot of different things. Or if the in the money bull put credit spread sets up and looks good, you can do that. So here's another chart, the hourly, showing you how that really nice break to the upside. And then here's the trade setup again. So Baidu was trading at $219.50. These were weekly options. Looking for expiration, was the 5th. And it actually did close at $226.70. So here's the trade setup. So this had 3 days. So the short leg was at $222.50. And a lot of times I will use also Fibonacci support resistance levels. So the short leg was $222.50. And at the time, the market was trading at $219.50. That's $3 in the money. Credit received was $181. So this was another $2.50 wide spread. So the max there, the difference, $69 per contract was your at-risk margin. And if this closes at $222.50 or greater, you keep the full 100% of that 181 credit. And you can see that would be a 262% return, or the positive risk ratio of 2.62 to 1. So here you can see the 181 credit, 69 max loss. And at expiration, you know, it was pretty much full 180 bucks over your max at risk 69, so that's a 260 some odd percent return. So that's another one. Here's Tesla, just another example. This back in November. This is a 3-day trade. These things a lot of times can be like almost a day trade basically. And this is another bullish target strategy. Pretty much kind of the same looking, similar setups. This is one of my favorite setups that I'm constantly looking for. And I've got a scanner that looks for these type trade setups. So you can see it's trending sideways here, that consolidation phase. Indicators are up, so potential for a break to the upside. So again, you can just buy the shares, buy at the money calls, buy debit spread, or if it looks good, attractive to you, sell the in the money bull put credit spread. So here it was traded at 241. The spread, the short leg was put on at 245. That was $3.39 in the money. Got a $140 credit. Difference was the $2.50 wide spread less the credit received. So your at risk is 110. That's the margin that you put up. And if it closes at that strike 245 or greater, you make 127%. Now the other thing to remember is that these are credit spreads, so it doesn't even have to close at that 240 strike to make 245 strike to make money. It can close below it, and because of the time and theta decay, you're still going to make money. So you know this, and your break even is pretty low too. So this is another great strategy, selling down here the 245, buying the 242.5 put. And so this was actually put on and then taken back off, I believe the next day. You can see the credit dropped here to 13 cents, so just bought it back at 13 and was out. So it ended up making 115% in 3 days. So the other thing that's nice about this type of trade strategy is that, you know, if you have a small account, you can do this, and it's a good way to build your account size and a good way to not have to expend a lot of money at risk. So here's another example. This is on a bear call credit spread. This is a bearish strategy, and this was on Netflix a couple of weeks ago. Same deal, but just the other way around, and also has positive risk. So here's my trade setup here based on my trading model that I use. You can see it was really consolidating sideways here. Here are Fibonacci levels that I use, and I set that to help me look at targets. So when I put this trade on, I was looking for it to hit that 236, and man, it broke out of that squeeze and just cratered and hit it the next day. So here was the trade setup. It was selling the 377.5 calls, buying the 380. So it's a in the money bear call credit spread. And for this, collected actually $142 credit. And then the next day, it dropped real hard overnight, or came in on the open and dropped down hard. And that credit that the day before was at 142 was now at 25. So I just bought it back at $25 and was out of the trade. And, you know, that was a 117% return there on basically a one-day trade. So that's the thing that the beauty of these particular trade setups is that you get totally identify your risk, and it's got a positive risk ratio, and I like them a lot. Now I like the out of the money ones too, and they're all, you know, different circumstances to use, but these are some other ways to look at your trades. So, you know, let's get into some questions here. But first off, though, let me just say I'd like to, you know, thank everybody for letting me have a little bit of your time here today. And hopefully what I shared with you will, you know, open your eyes to different ways to look at trading, or maybe it'll be something that you can start using tomorrow in your trading. So, you know, it's all about, you know, just continuing on that journey of learning. So hopefully this will be some stuff that you can use and want to incorporate now or later in your trading. And, you know, probably, you know, like a lot of you here, I have spent many, many years and a lot of my own money figuring out what I kind of know now. And what that is that what I've come to conclusion is that slow and steady is really what's going to win the game for you in trading. And what I've also found is that through the use of options in my own trading experience, I've become a more consistent, more profitable, and less stressed out trader by employing options in some of these strategies that I just went over with everybody here today. So I'd like to also share with you one really nice little email I received from one of my clients, and it just kind of gives you an indication of what I'm trying to pass on to my members and clients. So if you have a couple minutes, please take a look at this, and then we'll move forward. Now, if you've ever done any teaching, or just teaching your kids or whatever, you know how rewarding it is to get some positive feedback from somebody. So I really appreciated this, and it makes me feel good that I was able to help somebody, and that's what it's all about. So what I'd also like to do next, though, before we get into your questions, is let's talk a little bit about some simple things you can actually start doing now, additionally, to generate a more steady stream of income each and every month for yourself. And what I'm going to offer you here today is a really nice package. It's a very low cost package, but it's a great course. I did this just recently, and it's a course that was 100% on credit spreads. And this course, it was originally going to be 3 hours. It turned into 5 hours, but that's kind of the way I do it. I just keep going until I get everything taught that I want to get out there. So it's in 30-minute modules, so it's easy to follow. And even if you've never traded, this is a good step-by-step way for you to learn. And let me put the link in here for you. So if you just put that, copy and paste that into your browser, and it's powercycletrading.com/idea, that will give you this course and everything with it for $97 today. And also the other thing that in my courses, my PowerPoints, they're basically a training manual. So this is a 183-page manual on all the details of credit spreads. And I'll go through and show you everything that's in this course in just a second. But I also have one more bonus for everybody that's here today. Also, this is a money-back guarantee. If it's something that doesn't work for you, that you don't want to use, or that doesn't seem to suit your trading style, just send me an email and we'll refund your money. But it is a fantastic course, but it's all about everything I showed you here today, but 5 hours of it, because there's obviously a lot more to it than just 1 hour what I can show you. So I go into great detail, but it's a step-by-step course. So even if you're a beginning trader or beginning option trader, it's a great place for you to get started. And since it's recorded in modules, you can go at your own pace. Now, the other thing you'll get, which is a huge benefit, is for the first 30 that sign up here, you're going to get my follow-up accountability and support coaching Q&A session. This will be a live session. It's going to be in about 2 weeks. And so the first 30, I like to keep these groups small. So the first 30 that sign up here today, just all you have to do is buy the course, $97. You'll get a follow-up email when this is going to be set. It'll be probably 2 weeks. It'll be Tuesday in about 2 weeks. That's when I'm looking to do it. So it'll give you time to get into the course, get going on it, and whatever questions you have, then you can come back and ask those questions in this follow-up coaching session. So go ahead and put that in, but I'm going to be watching as orders come in, and I'll cut it off at 30. So hurry up and put them in there before that's filled up. But that's a really great addition. Now this course, what it covers is how to use credit spreads to create those low risk, high probability, less stressful type of trades. How to use credit spreads on stocks, index options, such as SPX that I was talking about. index, RUT, these type of index options. I like to do them certain situations. I like to do those credit spreads. And then how to use non-directional credit spreads and when, those iron condors, something that it's not something that you want to use all the time, but we go through when to use those. And then when and how to use those deep in the money credit spreads that I showed you a couple examples of, how to set your targets, how to use that implied volatility, the implied move. Spend a lot of time on that implied move to make sure that you understand exactly how that works, because that's such a great aha trading moment when you get when the lights come on that. And then, how to steadily and consistently grow a small account. You could see that positive risk ratio type trade setup where you're only risking 32, 33 bucks to make, 180. So these are type of things that you can learn to use to take that small account, push it to a bigger account with a lot less risk. And then I spent a lot of time in this course on how to defend. All of those examples, I said, well, this is the max you could lose if you do nothing. But the one thing on credit spreads, you always don't want to do nothing. You want to defend the trade if it starts to go against you. So I have 6 strategies that are taught in this course, all this in this $197 course that's 5 hours. And then when and how to use those iron condors and when not to. And then position sizing. I touched on a little bit, but I go through really good examples on putting basket trades together to spread your risk out. And then the really cool thing, this is worth $97 just here to see exactly what I'm talking about. How do you take a 70% probability and how do you turn that into 90%? So we go through that. And then step-by-step guide for executing the trades. Best technical analysis to use. Spent a lot of time also in the course using Fibonacci, showing you how I use that, incorporate it for my support, resistance, and target levels. And best market timeframes for certain trades on these credit spreads. I want to go out 20 days. Others I'll go out 50, and I'll show you and tell you how and when to do that, what type of strategies or structures or market conditions for those are applicable for. And then how to trade the spread end of the day, so you don't have to sit at your computer all day long getting bug-eyed, going crazy, and a lot more. So it's a really thorough course. And again, the first 30 here today, you'll get the course, all the recorded modules, all PowerPoint, 883 pages, and that live follow-up Q&A in 2 weeks. So hopefully you'll take advantage of it, and I look forward to working with all of you guys in the future, everyone that does decide that this is a good place for you to go. And being at the end of the year, you can take this as an expense and then use this to learn something that you can do and incorporate in your trading at the end of the year, in the new year. The live follow-up Q&A will be, I'll probably do it in the morning at 10:30 Central. So if you're in New Zealand, that would probably be workable for you. But again, it'll be recorded. So if you can't make it, you can email in your questions, and I will just take those questions and I will just go over it in the session. So if it's, we do that a lot. So if you could not make it, if you have a specific question, just feel free to email that to me ahead of time. Yeah, so let me give you that link one more time. And here it is. There you go. Sometimes you might use a different browser if you have a problem with it. I've noticed that sometimes Internet Explorer, it hangs up. So if you are having that experience, try a different browser and it'll usually work that way. Question is, implied move usually plus or minus 4% on all stocks? No, good question. No, they're always going to be different. Every stock will have a different implied move. So that's something that you'll learn in the course, how to calculate that implied move, how to find it, how to use it. So once you know what it is, then how to use that for your targets. And then the next thing is, okay, I've got my targets, then what kind of trade do I want to do? Then how do I structure the trade? So that's all outlined, and that's a big part of the course is that implied move and how on any platform to find what that implied move is. Some platforms are easier than others, but I go through examples of all the different ways to do it. So there's no problem there as far as at the end of the course you'll know exactly what the implied move is on any underlying that you're interested in and how to calculate it really fast. So spend a lot of time. That's a big chunk of it. So it's a very good question. Well, if the metaphor platform has options, does it have options series? If it has options, it does work on it, yeah. Anything with an option series will work. So any platform you have, any brokerage platform, as long as if it has options on your platform, then in this course you'll learn how to do those implied moves and figure out the trade structure and all that stuff. So you don't have to have a fancy platform. I like to use Thinkorswim, and I have TradeStation, but my trading model that I use, I've got it coded for Thinkorswim, TradeStation, NinjaTrader, and eSignals. So, they're all great platforms, but some you know how it is. You get familiar with one thing, you don't want to change. You're welcome. And here's that link again. Now, once we're full on that 30, then I'll cut it off. But you're still welcome to buy the course. But I'm just going to keep that follow-up Q&A group small so I can make sure I have can answer all the questions. Yeah, IB platform's fine. Yeah, any platform with options is fine. There's no problem because I'll teach you exactly what you need to know in here. It just it's not that. I mean, it sounds real kind of complex when you say standard deviation and all this stuff, but it's not. So that's once you go through this course, you'll see it'll be very clear to you. Well, yeah, delta of the options are important, but for income option strategies, the delta is one thing, but you also really need to know what the implied move will be, and you also need to understand timing data. So that's all explained in the course. It's not that hard, and never. If you're unclear on it, this is a great way for you to get some clarity because for $97 this is a great course. I mean, I don't mean to just say that. It's a great course. But I did this course, and it's just there's so much interest in it. I've just kept it at at this price point because it just gets a lot of value to a lot of people. Yeah, the implied move. Yeah, so you'll know exactly what the implied move is, what that means, and then the main thing. Well, then how do you use it? How do you make money with it? So you'll walk away with it with a lot more than $97 profit. You'll cover that pretty fast. So I'll just show you kind of here, if you can see this, show you my trading platform. And I like to use these strategies for directional trades, but I can also use the same strategies for non-directional. It just depends on what it is. So here you're seeing this is my trading platform that I use. So this is Thinkorswim, and whatever I'm looking at, if it's a good directional setup, the setup comes first, and then the option trade will come next. And if I see a good setup, then I'll look at the various different trades, and I usually always start with looking for a credit spread setup. So let's just try to think if I saw anything. Well, the other day I just did Facebook, and now this is a pretty cool thing too, is that Facebook, you have a lot of stocks now that have dollar widespread. So you can really get low risk. I did a Facebook trade where I did this in the money credit spread, and it was a 1-to-1. So I risked 50 cents, $50 to make $50. That's not bad. I mean, if you got a small account, you do one contract, you make 50 bucks. Worst thing you could do is lose 50. If you have a big account, you do, 10 contracts. No, toss is not essential. No platform is, if you have options on whatever platform you use, that's all you need. If you have an option series, right, if it shows you, a series of calls and all the series of options, any platform. I like Toss, and it's a free platform, Thinkorswim, it's free. You just open an account at TD Ameritrade, it takes you 10 minutes, 15 minutes max. Download Thinkorswim, and you're good to go. So here is, see here, so you see this Fibonacci levels. I'll teach you Fibonacci, how to use them for these type of strategies. But here's Facebook when it was trading right here, coming into that 618. I put on the 76.75 bull put credit spread, and it was a 1-to-1, $50 to make $50. Look at that, boom. See the indicators, momentum up, sweet little setup, really low cost. Yeah, if you like IB, that's fine. But Thinkorswim is a fabulous platform. I mean, for options, it is just unbelievable. I don't work for TD Ameritrade. I don't get paid anything by TD Ameritrade. But I'm just a user of it, and I love it. Now, I also use TradeStation because I have most of my trading money is at TradeStation. But Thinkorswim is an awesome platform. This is Thinkorswim. So I've got this, with my model, and I use the platform, and it's all good. And like I said, it's, you open an account, it takes you 10 or 15 minutes, and then you can download the option platform, and they'll let you use it. They're great, and they've got great service too. So I'll give them a good plug. Yeah, great, Henry. Look forward to it. I'm glad you signed up. You'll learn a lot of good tricks. Yeah. Well, one thing, you can trade a lot of these strategies, but you're always going to pick up something else different. I've got, for my members that I have, I've got some great traders, and I'm constantly picking up new things from people that I work with, that I'm teaching or showing them my trading ideas and stuff. I'm also getting great trading ideas from them as well. And it's always about honing your skills. Again, there's no perfect trader. There's no perfect system. It's just a continuous journey. And that's what makes it fun too, man. It's a continuous journey to learn, right? Keeps your mind active. And that's what I like about options. It's very thought-provoking. Yeah. Now, don't get me wrong. I like using a lot of different option strategies, but the credit spreads are my go-to first. I usually always look at those first. But I also like to do debit spreads. I'll just buy directional calls as well, or I'll do a combination basket of all of them together in certain situations. Yeah. Yeah, so I cover all of those that I mentioned tonight. The out of the money, in the money, those are at the money, those are the main ones, and then just the bear call credit spread, bull put credit spread, and iron condors. And that's it. You can just, it's a 5-hour course just on that. And there's a lot to be learned about it. But it's it's very basic and very simple, but there's a lot of little tricks and stuff, like you said. They are enough, yeah. They are enough. Yeah, me too. I like simple. Real simple. And my teaching style is to make it simple, not real complex. I teach you the foundations and the basics that you need to know. And I always start out with the foundation to make sure you understand the main components foundation. and then go from there. So, we'll spend a little time on those option Greeks, which to a lot of people sound like too much work, but they're not really too much work once you understand why they're needed. Thanks, I appreciate that. I try to be a good teacher, so it's patience and just trying to take it, step by step. And I'm a visual learner, so the way I teach is with a lot of examples, so you can go back and look at the trade examples and go at your own speed. Here's that link one more time in case you need it before I sign off. So you just copy and paste that in and you'll be good to go. All right, guys, any other specific questions here? Yeah, thanks, Henry. I'll see you online in about 2 weeks, too. Well, you don't have to sign up for the live. You'll get an invitation. So you buy this course, you go into my my little database. You're registered. Then you'll get an email telling you the exact date, and I'll give you the registration link. So as soon as you sign up today, purchase the course, then you're on my list, and you'll get that follow-up bonus Q&A. Thanks, Reese. I look forward to it as well. Thanks, Long. Specific you guys would like me to answer about credits or credit spreads or options or anything? I'm open for another few minutes here. Yeah, thanks, Jan. I appreciate it. And everybody, good luck trading, and I hope to work with as many of you as I can in the future. Thanks, Jana, for having me here today.